What's up, guys? Welcome to our live stream today. I think this is a very important one. What's interesting to me is Lululemon has fallen a lot lately, and a big reason I like this live stream today is because, not to say that Lululemon's a company that everybody should be buying. That is not my opinion at all. There's a lot of we have a video coming out about Lululemon, but I want you to thank you guys for coming in, because one of the most important aspects of investing is, where do you find your ideas? I was talking to Mo recently, and I asked Mo, because my life is changing and I'm trying to change like how I work and stuff like that. I said to Mo, Mo, do you ever get bored? Because Mo's basically retired. I mean, he works on this channel, but he does it at his own pace essentially, and he's basically retired. And he said, no, but I sometimes feel guilty because I'm not finding more investment ideas. To which I said, don't worry about that. Let the investment ideas come to you. Yes, be aware of them. Be aware of what's going on, but don't force an investment idea. This is why I love dollar cost averaging. And I told him this, I go, Mo, maybe you should dollar cost average more into ETFs and sell more cash secured puts into ETFs, because this is why we love covered calls and cash secured puts. It keeps us busy. It keeps us from making these forced actions that may not necessarily be a good action. So one of the most important aspects of investing is, where do you find ideas that then you can go peel apart? And when I say peel apart, guys, my personal opinion, and this is not Dalton's, this is not my friend Gary, my personal opinion is, I want to find large companies that are temporarily mispriced. It does happen. Doesn't happen as much as micro cap or small cap companies, but it does happen. That's my goal. So the question becomes, how do we figure out what's an undervalued stock? That's what we're here to talk about. The step-by-step process for looking for companies, then figuring out, hey, how do I determine if this is undervalued or not? Okay? Because remember, following the hype is exciting. But at the end of the day, if you follow the hype with no process, what's going to end up happening? Well, history shows us that at every market peak, it ends up being poor after a while. Now, of course, I've been saying for the last 4 years that the market is massively overpriced. I get it. I do get that. Actually, I've been saying it longer than that, but I've been out of the market for a very, very long time. Now I own 28, 30 companies I've had for, 2 years. And it's funny because those stocks are up a ton, and I don't feel like I'm any better of an investor because I bought those stocks. Because when I hear people say like, oh, Paul, because of you, I bought, I'm like, yeah, it's not because of me. It's because the market's up so much. I want to look at it, years down the road and say, yeah, this process worked. That's why the dollar cost averaging is such a great method. Something that I do, guys. I dollar cost average into ETFs for a chunk of money, and then I wait for these opportunities to come up. The other thing is, I can make 4.25%, 4.5% on 90-day treasuries without doing anything. And for me, that's enough because of my financial situation, because I have 1,000 apartments upstairs. I have all these things that we're doing. I don't need to make a killing. That's not for you. And that's what I want everybody to remember. What makes sense for me is not going to make sense for you. The companies I look at may not work on here. And this is exactly why I'm teaching on YouTube, because I want everybody to realize that investing is a personal thing. What's going to make sense to you will not make sense to somebody else, or it might make sense to them, but it isn't the right plan for them. Warren Buffett is not going to invest like you and I. He should not invest like you and I. But 25-year-old Warren Buffett invested a lot different than 95-year-old Warren Buffett. I hope everybody's understanding this, because this is one of the most important aspects about investing, is understanding what you need to accomplish, why you need to buy what you buy. This is so important to everything we do, every single thing we do. I was upstairs right now clicking away about apartments. My brother and I were talking. We have a lot of apartments in Columbus, and they're all timed the right way to have a refinance in 4.5 years. Well, we don't owe a lot on them because the value has skyrocketed in the last 4 years because of the rent increases and all that stuff. But my brother was saying to me, hey, how much debt do you want to take on? I'm like, well, we think it's worth this, blah, blah, blah. You know, I sit there and say, if you put 70% of a loan, blah, blah. At the end of the day, he goes, okay, how much do we have to increase our operating income by in the next 5 years to justify this? Well, I said to him, I go, but here's the thing. We have very low debt right now. So we're going from 45% debt to 70% debt. It's not like we're going from 70 to 70, so you don't have to increase. So we're not only increasing the debt, but also our average interest rate is going to be much higher, because right now our average rate on those loans is like 4.5% because we got the loans 3 or 4 years ago. These are the things I talk about. These are the things that I have to think about that you don't have to think about. But there are things in your life you have to think about that I don't have to think about. This is why investing is so personal. But with that said, principle-driven investing, these 5 tenets, are so important because it doesn't matter what you're investing in and why, these matter. These are an intrinsic, fundamental truth that apply to everything. It doesn't matter what you're doing, these do apply. All right? So I'm not here to tell you guys, I love the companies I own. I don't think there's a single company I own where I go, I hate this company. Why do I have this stock? I sit there and say, listen, some of them are harder than others, but there's a thesis to them that I want. Fucking Alibaba. Did you put that up there to troll me? I mean, guys, look at Alibaba. It's, you know, I remember when it was $60, $70 a share, people were like, you're an idiot, Paul. You don't get it. I'm like, okay, I don't get it then. And it's at 146 now. I'm not taking a victory lap. Even though it's up, because, you know, my basis is somewhere around, I don't even know where my basis is, because I started buying sub 150 and then I was buying all the way down through 70 and 60. I have a full, it's funny because yesterday I was upset about it, and Nick, he goes, Paul, you had plenty of opportunity to buy it low. I'm like, no, you dick. It's about my covered calls, not about the stock. I want the stock to keep going up 100%. But this is a company that I had a big position in, and I still do. And again,
will you roll your options?
I don't think the options are, I don't think we triggered the options. I don't think we're above. I'm just sitting there saying, like, if it keeps going up this fast and in the next 3 weeks, yes, then my options are a problem.
Gotcha.
Yeah. So I don't like big jumps. Big jumps don't get me happy. Big jumps scare me, but it worked out for me. Can you pull up Sprouts Farmers Market? I own Sprouts in the low 30s. We lost them at 165 on covered calls, but look at it now. It's at 136. So that worked out for me. Okay, it worked out for me there. But I'm not buying Sprouts right now because I didn't think it was worth 136. But I didn't sell it because I was just like, you know, I learned my lesson from Microsoft and Meta. You don't sell just because you feel like something's slightly overvalued. I think Sprouts at 136 is very overvalued. But I was like, but it can really keep going and going. The bottom line about this is, investing is not this like short-term thing about, and if you have this short-term outlook, it's going to cost you money. That's why dollar cost averaging is so brilliant. It allows you to stay in the market and ride it up, and you be patient for the right time to buy. So, what are you laughing about?
He says, in fairness, Nick, you can put
that's funny. Matt, that's a really good one.
Paul, no one knows as much about Palantir as Palantir knows about all of us.
I did not sell Target. I still own Target. And Target, I'm down on. I think my basis in Target is probably 115, 120. I'm not worried about it. That's the thing, guys. Like, I don't look at it going, oh no. I look at it going, okay, I have a thesis on Target. I hope it works out. My thesis is a 10, 20-year thesis. That's it. I do not worry about my day-to-day interactions. In fact, I say this all the time. When I log into my brokerage account, I hide the balance. And the market's up a ton. Most people are like, yeah, this is great. I do not want to fall in love with that high balance. I want to fall in love with my process. That's what I'm in love with. I do not look at my balances ever. Ever. I try not to. Sometimes I like click on something. I'm like, oh, son of a gun. I saw the balance. And I get a little tickle in my pants. And I go, oh, well, that's a problem. So anyways, so what are these 5 tenets? 1, we are investors, not speculators. Guys, you have to repeat these 5 tenets to yourself all the time. What this means is we're not hoping for the market to pay us more in the future. We are buying businesses, and we are buying them at prices that make sense. And we know that in the long run, if the fundamentals of the business 10x, the stock will likely 10x. If the fundamental, I love this one. I've been using this one like crazy lately because look at Cisco. This max chart on Cisco. Take this out. let me get green on here because it makes, let me get green right here. And then let me get black right here. So let's look at this. If you take out this part of the chart, this peak in 2000 when Cisco was the winner, was the NVIDIA of 2000. How does this chart look? Actually, I don't even need to do that. Let's just do this. How does this chart look? Guess what? This point right here to this point right here is about 10x. And guess what the profit is? About 10x. That's not a coincidence. Now, we just get stuck on, oh my God, Cisco was at $82 a share back in 2000. Yeah, but it made no sense. It made 0 sense. Look at Palantir today. It makes no sense at this price. Ironically, when it was $45 back in 2021, February of 21, I said it doesn't make sense. I'm interested at $5. I love that everybody's making fun of me for missing out on Palantir because it went to $5.83 and they're missing the story. It went to $5.83. It wasn't worth 45. Do I think it's worth what's it at right now? 170? I don't think it's worth that. But do I think it's a great company that has high potential? I think Alex Karp's a psychopath. And I do worry about Alex Karp. But it's at 157 right now. Okay, it's not, this is the same thing. Palantir could be a great company, but like I always say, this is the later tenet. I'll talk about that. Second thing, every investment's the present value of all future cash flow. For Cisco, that future cash flow made no sense here, made a lot of sense right here. 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 But here it made no sense. This is what's important. The more you pay for something, the lower that present value is of all those cash flows. It just makes the return shit. That's it. That is it. Number 3, if we don't understand it, we don't invest in it. Guys, I think there's an argument to be made about Palantir when people say, I don't even know what they do. It's kind of a generic thing they say. If you don't understand that, don't invest in it. I don't blame you for doing that. I don't like the way Palantir handles their books sometimes. There's been some shaky accounting things they've done in the past. Am I right on that one? I don't know, but I'm just like, if I can't understand what they're doing with their books, I probably shouldn't invest in it. If you don't understand that NVIDIA has 23% of its revenue coming from one company, if you don't understand who that company is and what might happen in the future, don't invest in it. It's very simple. There are plenty of business. There's 10,000, 20,000 companies out there publicly traded. You'll find a group of 200 that you understand, and you'll find 10 or 20 that make sense in that group. But what we find is everybody's focused on trying to find an investment and justify it. It doesn't work that way. Number 4, in the short run, stocks are a voting machine. In the long run, they're a weighing machine. 10x revenue, 10x profit, 10x stock price. This was just the voting machine. Cisco's the best thing ever. Cisco's the worst thing ever. That's it. Amazon fell 95% from here to here as well. But guess what Bezos always says? He's like, yeah, our stock fell 95%, but our fundamentals were all intrinsic. All our internal numbers were way better. It was just the voting machine working. And the 5th and most important one, a great story can become a bad investment if you pay the wrong price. This is probably the most important thing we have to understand, guys. And unfortunately, hype is when we pay more for the story, where we don't understand the numbers, where no price is too high. Now, you might sit there and say, well, no, there's a price that's too high, but that's not what we're doing when this is happening. We are saying there is no price too high because this is completely, intrinsic value here was this. That was intrinsic value. This is story and hype. You're not right because of this, just like you're not wrong because of this. That's what's key here. So, how do we find a good stock? Well, remember, guys, I got a question. I had a friend of mine ask me the other day a question. He goes, Paul, actually, let me find it. But basically, he said, Paul, what's a great company to invest in? I said, are you asking me a great company to invest in or a great stock to invest in? Because they're very different things. Company and stock price are very different things. Very different. Cisco has a bad rep because of this. I would argue Cisco should be revered for this, steady growth. One is the stock price, one is the company. Do we understand the difference? That's very important. When you buy a stock, you're buying a piece of a business. That's what you're buying. So what's a good story? Guys, I like this Peter Lynch method. Go out there and see what products you use every day. What are you using every single day? There's probably a lot of great companies that you use every single day. The question is, are they selling for a great price? What do you use? You use the iPhone. Okay, is Apple great? I don't know. Let's look into it. It's a great company. Is it a good stock? That's the difference there. A stock is only good when the price is below value. That's when a stock is good. Now, how do you determine the value? We'll get to that. That's the hard part. But a stock is only good when price is below value. When you go to the store and you see your favorite pair of pants selling for $89, do you go to the register and say, guys, this is my favorite pair of pants. I got to pay you $150 for this? No. Let's say, for example, you knew that there was $100 in one of the pockets. I don't know why. Forget about the morality of it and somebody lost $100. Let's just say that you knew that there was $100 in one of the pockets. Would you pick up that pair of pants for $89, go to the register and say, hey, listen, there's $100 in here. Charge me $189. No, you'd say, I'll pay $89 for this. I just got myself a pair of pants for free and got $11 in my pocket. That's value investing. The hard part is nobody really knows what's in the pair of pants. That's the hard part. That's what makes investing difficult because there's always a disagreement. Guys, I've got great investor friends and we don't agree ever on certain investments. You know what we do agree on? Our philosophy. The philosophy is just exactly we're walking in step here. You've got to be able to value business without looking at what this market price is. This is Mr. Market acting crazy. That's Mr. Market acting crazy. You have to be able to say, okay, I know what the market's doing, but what's the stock price doing? So we talked lately about Lululemon. Let's pull up Lulu. This is a company that's up 1,100% since it went public in 2007. But look at this. Its all-time high was 516 less than 2 years ago. And now it's at 166. Okay. People who follow stock price are going to say this is a dud stock, just like PayPal. It was awesome at 310, just like Alibaba. It was awesome at 300 some. No, it's the same company, guys. The same future exists on PayPal, Lululemon, Alibaba, no matter what price you pay. The company does not care what price you're paying for the stock. What it cares about, Amazon, Jeff Bezos did not care that you paid 95% less for Amazon in 2002 than in 2000. What he cared about is our internal numbers showed us, and you can Google this. There's a whole video about it. He goes, yeah, but then I looked at all our internal numbers and all internal numbers were up a ton. It was crazy. It was absolutely crazy. You guys have got to focus on Mr. Market. Sorry, ignore Mr. Market here. You've got to focus on fundamentals. Because look at this. Right now for Lululemon, let's go back here. The first time Lululemon hit this price was essentially 2019. What is this date? Let's go back here. When was the first time the high was above? Okay. 2019. March of 2019 was the first time Lululemon hit the current price. Let's go look at revenue. Well, guys, ready for this one? Current revenue is about $11 billion. In 2018, because it was early 2019 when it hit. So you're looking at the financials from 2018 when you bought it. Sorry, $2.65 billion. It's 4 times higher. Okay, let's look at the profit. The profit back then was $258 million. Now it's $1.8 billion. That is at least 7 times higher. The stock is 165 versus 165. So the question has to be asked, was it overpriced here? Was it underpriced here? Were they both undervalued? Are they both overvalued? I want to show this to you guys to say Mr. Market doesn't have a clue what's going on. The stock is a $20 billion market cap right now. It was a $20 billion market cap back then, probably higher. They probably had more shares outstanding, but now it makes $1.8 billion. Back then it made $258 million. I really hope people see this for what it is, because that's a brilliant way to look at things. And I'm not saying that because of me. It's just a brilliant way to understand that markets are irrational. Markets are absolutely irrational. B, I hope you're right. I hope Lulu is headed to 150. Now, You might sit there and say, well, Paul, if it's so much like this, why don't you own it? Well, watch our video and I'll explain to you why I don't own it. Tomorrow it comes out on the main channel. It's going to be a great thing to look at. But please don't confuse price action of a company with quality of the company. Your job is to look at the company. What you should do is you should ignore the stock price completely, value the company, and then go and look at the stock price. That's why we have our stock analyzer tool, right? Our stock analyzer tool focuses on these fundamentals. And then when you hit analyze, then it says, okay, here's what it is. Here's a return based on the current price. If you paid it today, here's what you should value this company at. That's what's important. So why do we buy great companies at great prices? Well, Warren Buffett has that quote. It's far better to buy a great business at a fair price than a fair business at a great price. He's 100% correct. But I would disagree on one thing. You can buy great businesses at great prices. It's happened many, many times in history. You got to be ready to pull the trigger, though. I would argue that Meta in 2022 is a great business at a fabulous price. That's why it didn't stay down there very long. You have to be ready to do that. That's why I focus on dollar cost averaging. I really want to get into this because my life has changed a lot. I run the numbers on my life. And essentially, if I can make 5%, if I can make 4% a year, I can live the rest of my life. Actually, I can live the next 100 years of my life on spending 50% more than I spend today. And I spend an absurd amount today. So you might look at that and go, well, go take more risk because you can afford it. No, I look at it and say, no, I'm going to do what makes the most sense because I don't need to make 20% a year. I have real estate. I have stocks. If my stocks make 10% a year and my real estate makes 15%, I have more money than I ever need. Hell, if my stocks make 6% a year, my real estate makes 10% a year, I'll have more than I ever need. So I'm just looking to do what makes sense and just be rational about it. I love dollar cost averaging, but every so often there's going to be stocks selling at interesting prices. Louis Vuitton is starting to sell at an interesting price. When do we do that video?
This is a teaser. Same video.
Shit.
And I said tomorrow, but it's actually Thursday. I forgot
For
about
what?
that.
Lulu?
Louis and Louis will be in a Thursday video.
Yeah.
You'll have to find out what the other stock is by watching it.
Yeah. If you know, the great thing you guys all have is you don't need to time the market. You just need to be dollar cost averaging for decades and you'll do very well. But if you like picking stocks, and I love it, take 10 or 20% of your money. Take the money over what you need to hit your retirement goals and dabble. But you got to be ready to buy at the right time. And the right time is very difficult. Why? Because when Google was at $85 a share, people were saying, we got AI's changing it, blah, 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 all these other things. Now it's at $240, and that was not very long ago. When Meta was at $88 a share, Zuckerberg's an idiot. He's past his prime. This company doesn't make money. Nobody uses Facebook anymore, blah, 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 blah. Now it's at $700 some a share. Zuckerberg's a genius again, etc. News follows the stock price. These are the foundations, guys, that we're talking about here. This is the stuff. And you know what? I'm going to repeat them ad nauseum. You know why? Because you need to hear it ad nauseum. You need to repeat these things to yourself. I repeat these things to myself over and over. And guess what? It works. It absolutely works. I still remember the first time I realized this. Real estate helped me get there. I started getting involved in real estate. And I thought, oh, real estate just goes up in value. Yeah, but I could drive. Then I realized I could drive that value higher. Why? Well, if I bought a property based on income, if I was able to increase the income a lot faster than the market, than the inflation did, my property worth more money. Boom. Made perfect sense to me. Then I thought the same thing about stocks. Wait a second. So I buy a company that makes $1 billion a year for $5 billion. Sorry, for $20 billion. So 20 PE. If they make $10 billion a year in 20 years, it's probably worth 10 times more. That makes sense. Now, the hard part is finding those mispricings. That's what's very important. So how do you do it? So first off, do we have any questions? That's because I have 100 million. I don't have 100 million, but Dancing Diamonds, I get what you're saying. I have a lot of money. Don't get me wrong. And you're right. That's exactly why I talk about that, because I have an F load of money. But it doesn't mean these principles don't still apply. These principles apply no matter what you're doing. The way in which you apply those principles, it depends on your situation. And that's what's really important. So I'm glad you said that.
Paul, what would you say? I have a question. What would you say to the person that maybe didn't start investing in their early 20s like we should.
Yeah.
Or even in their teens like they should. And they feel like they're in their 30s and they need to get into the Palantirs or NVIDIAs in order to make up for.
I don't blame you for thinking that way, but I'm just telling you it's not going to end well. It's not going to end well. The hype never works in the long run when you're just following the hype. It's unfortunate and it sucks. And sometimes you got to feel that to go with it. What I would do if I were you is start buying real estate, dollar cost average into low cost ETFs, and be ready to buy QQQ when it falls to much more reasonable levels. You can still make up for lost time that way, but you got to just be smart and patient. Smart money always beats, and that smart, when I say smart money, it's not the big time institutions out there. It's the discipline.
Did you get your Diet Coke at McDonald's today?
I did. And by the way, to B's comment, we didn't have Allo and Vori 10 years ago. We did have Vori 10 years ago. I remember owning Vori 10 years ago, and I was teased by my buddies at basketball night. What's that V on there? I won't get into it, but I don't wear Vori anymore, but it's great. And you're right, though. The thing you're going to watch the video tomorrow night because you're going to see my comments on Lulu. And I think it's very, very applicable what you say there. So, guys, at the end of the day, it's all about finding good companies. One of the best ways I think to find new companies is 52-week lows. And we have that on our site here. So if you go to stocks and you go to 52-week lows, no better place to find a company than what companies are selling near their 52-week lows. It doesn't mean just because they're at a 52-week low, it's a good price. It does not mean that. It does not mean that. What it means is that the market is saying this company is poop right now, and you should take a further look. That's what it's saying. You know, I always see on Twitter, like there's guys who say, oh, this company is selling for 50 times earnings, which is the lowest it's been. It's the Meet Kevin idea of, oh, Tesla's selling for 130 times earnings, so let's be conservative and call it 70. No. The market history average is 15, 16, 17. Some companies deserve a premium to that. Some companies deserve less than that. Just depends what kind of company it is. But start with a 52-week low business. Go in there, screen through these 52-week lows. Just start looking through, and it'll just keep popping up. These are the 52-week low companies.
And then we also have the near 52-week low.
We also have the near 52-week low.
We also have that. So if you
near 52-week low.
So that it's within 5%.
Within 5%. It's probably going to be more of these. Oh, wow, a lot more of these. There you go. This is a great place to start. Another great place to start is, what companies do you spend money on every single month? Take a look at them. I will be honest with you guys. Find the boring ones. The boring ones are the ones that sell cheap. The boring ones are the ones, except for Cintas. Cintas is one of my companies I want to own. Look at this stupid company. Where is this? Cintas is such a simple business, and it's selling for 47 times free cash flow and 45 times earnings with an annual growth rate of, according to analysts, they're going to grow at 7% a year of their revenue, and their profit at pretty high number, but it's just funny to me. Cintas, the uniform people. This is a company based in Cincinnati, Ohio. They do uniforms for companies. They launder them. They put them back. They do like the placemats and all this. I'm like, come on, Cintas? Great company. I don't know if I like this, the valuation. Look at the 8 pillars here. We got all check marks except for huge valuation numbers. Doesn't mean it's cheap. If I were to tell you tomorrow that Cintas is going to increase its profit by 50% a year for the next 20 years, this is dirt effing cheap. Dirt cheap. But these are the important parts. Then when I get these companies, I look at the 8 pillars. 8 pillars is not about buying and selling companies. It's about what story does this tell? Well, high return on capital. Okay, that's a premium company. Buying back a few shares, 5%. Cash flow has grown $700 million in the last 5 years. Net income has grown $900 million. Okay, so why is free cash flow grown less than net income? That's an important question to ask on this revenue growth of $3 billion. So it's about 25%, 24% growth on this. Pretty good. Because look, if I look at this saying, okay, if their free cash flow and net income is growing, it's going to be 30% of their revenue increase, then over time, their profit margins can go higher and higher and higher, right? Because if their gross margin is 30%, sorry, not the gross margin. Let me play it this way. They increased revenue by $3.3 billion. They increased their cash flow by $700 million. That's about 25%. But their bottom line profit overall is only 17.5%. So when their their growth of the profit is higher than their bottom line, it means that as time goes on, their profit margins go higher and higher. That probably sounded confusing. I get it. It's a little overwhelming, but this is a good sign to me. It means that over time, as they grow further and further, their profit margins are going to go higher and higher. All things the same. That's pretty awesome. That's the kind of company you want to own. The question is, at what premium? Is that a reasonable premium? Well, we're not there yet. That's why we have Stock Analyzer tool. But that's why we look at Stock Analyzer tool. Story and numbers. I put some numbers together. It told me a story. Now I got to put those together to sit there and say, okay, what's this thing worth now? You go to the Stock Analyzer tool and say, okay, I got to make assumptions. I went to the analyst estimates. Remember, analysts are just making assumptions about the future. But look at this. Boy, look how tight this revenue growth is by year. Everything's between 7 and 8%. That's incredible. Okay, so maybe they're right. Or maybe I want to be more conservative. I don't know. I tell people, put your real assumptions here. And then for your conservatism, make your desired annual return, your margin of safety. Make that return higher if you want to be more conservative. Require a higher margin of safety. So if we believe that 7% growth forever, let's go with 4. Let's go with 5, 7, and 9% revenue growth. I went a little bit lower, a little bit higher. I don't recommend doing like 6, 7, 8 because you want to be more conservative on the low side. You want to be more aggressive. If we have more inflation than we expect, that's likely to happen. Now, profit margin. Guys, what was I saying earlier? In the last 10 years, they did 14.5% profit margin. Now they're doing 17.5%. Exactly what I said. As their revenue goes up, their profit goes up. So I'm going to sit here and say, okay, let's call this 16, 18.5, and 20. Let's call it 16.5, 18.5, 20.5. Free cash flow, it's been a little bit lower. So let's go 15, 17, 19. That's what I'm doing here. I'm just comparing. It was pretty consistent in the last 10 years, higher free cash flow. So this actually recent might be a fluke. So I'm actually going to go back here and just change this back to 16.5, 18.5, 20.5. Because over the last 5 and 10 years, it's actually pretty consistent. It was lower over the last 10 years, higher in the last 5. So, okay, this is the way I'm looking at it. This is the way I'm looking at it. Now, PE. This is the hard question. What's the right PE to apply to this company? Well, there's things that affect it. 1, the market does about 15 or 16. That's where I'd start. I look at my return on capital. Guys, their return on capital is getting higher. This says that when they invest money in the business, they get a high return on it. And the higher and higher it goes, the more and more this is considered a moat and a great business. So you want to immediately go, okay, it's not a 15 PE company, it's higher. Then you look at it and say, okay, is it established? Yeah, if I asked a million workers in this country who have uniforms, who are the uniform people, how many are going to say Cintas? It's probably a brand and it's under the radar. Okay, that's a little bit of a premium there. There's other things I sit there and say, okay, the balance sheet is good. They didn't have a lot of debt. If you looked at their 8 pillars, et cetera. So I'm like, okay, I'm looking at this saying, guys, I'm going to call this 17, 20, and 23. I might sit there and say, Jesus Christ, Paul, 20? Yeah, it's a lot, but this is a great company that can increase its profit as time goes on just by growing the business at a 6 to 8% clip. That's pretty awesome. So I'm okay with that. Now, you might look at it and say, Paul, this is a boring loser company. I want 14, 17, and 20. More power to you. You might be in Cincinnati and know how amazing Cintas is, and you're like, no, I think it's 20, 23, and 26. Whatever the numbers you put in, that's what makes this so amazing. You can make those numbers yourself. Remember, Warren Buffett and Charlie Munger always say, if they both were to value Berkshire Hathaway, they would come up with different values. But the point is, they want it so that it's so obvious that it's a good deal. So, desired return, 999. Now, I do this for my intrinsic value, the market return. But remember, this is where you put your margin of safety in. Because if you're not going to buy with margin of safety, just buy a low-cost ETF. There's no reason to have a company. You're going to put in a higher amount. How much higher? Depends. Watch our video on Thursday about Lululemon. You'll see what I explained there about margin of safety. It all depends on how much you understand the company. How badly do you want the company? All these things that matter. How long do you want to own a company for? Lulu versus Nike. Shouldn't your margin of safety be lower for Nike than Lulu? I would think so. Those are the things. Hit the analyze button. The stock's currently at 200. All right. This tells me that I'm nowhere close. 80 to 165. Just to show you how that means, let's say you thought I was being too conservative above. Let's say you thought, no, Paul, this is more like 6, 8, 10. Let's go 17, 19, 21, 17, 19, 21, 20, 23, 26, 20, 23, 26, and then 9% return. Look how much it changes it. Yeah, the highest level is getting there, but still in the middle level, we're still too far away. That's what's important to understand here. We're just too far in this one. Let me go to my history and delete that one because I don't want to keep that one in there. That's what's important to understand here. We're just too far. Now, does that mean F this? No, it just means, guys, add it to your watch list now. If it's at 115 based on the normal market return, you probably want to buy it sub 100. You're like, oh my God, that's too low. Well, go look at all the major companies. Netflix at one point went from $700 a share to 150 in a matter of like a year or something crazy like that, maybe 2 years. These things happen all the time. Nike went from 180 to $60 a share in the 50s at one point. Was it 50s? I don't remember. But the bottom line is at 180, we're like, yeah, we'll take a look further at under 100. You're never going to see under 100 for Nike. That's impossible. Guess what? In a raging bull market, Nike fell below 100. It fell below 70, 75. Any of these things can happen. That's why you add it to the watch list. For Cintas, I'm going to add it sub 100 because I don't want it at 115. I want it at 100 or lower. And by the way, if the stock falls below 100, I have to evaluate it again, saying, okay, are my assumptions still true here? Let me see what I assumed before. Maybe things got better and I go, oh shit, it's below 100 and I think it's worth 130. This is even better now. So maybe you put it at 115 because it might take some time to get there. And by the time it gets there, it's 115 is a screaming price for it. This is all part of this is all part of the process. I'm going to tell you guys right now, it's fun as F. It is so fun to do this. You just got to remember that pulling the trigger, only do it when you feel good. And then the other thing is, if you were able to get this company to 100, in your head, you got to remember that it could fall to 50 or lower. If you're not capable of handling that, don't buy the stock. It's easy to say it in hindsight. Guys, I will say this till I'm blue in the face. This story is a great story. It's about the emotional aspect of investing. In 2005, 2006, two of my friends had just moved back to Cleveland. They got good paying jobs. They said, Paul, would you meet with us to talk about our savings? I said, sure. We started doing the numbers, and they were well on the path. They were great earners, and they didn't spend a ton of money. They lived a great life. I said to them, guys, if the market fell in half tomorrow, what would you do? And the wife looked at me and looked at her husband and said, well, we'd buy more, right? I said, perfect. You get it. You're going to do great. Fast forward, 08 happens. Early 09, late 08, I get an email. Paul, oh my God, what is going on? I can't believe this. I'm so scared. I'm like, well, I'm buying more. How are you buying more? You're actually doing that? Yeah, didn't we discuss this? Yeah, but back then we didn't think the world was going to fall apart. I'm like, well, what else causes what else causes stocks to go down 50% is everybody's perception that the world is falling apart. Remember, it's easy to say that I would buy Cintas at 50. But when it goes to 50, the news around it is going to give you the reasons why it's going to 5. Not why it's going back up to 200. Think about every company that's fallen in price. When it falls in price, it's never about why it should be higher. It's about why it should be lower. Just like when stocks go up like crazy, the news is really about why the stock should go lower. It's always about why it should be higher. This is why when stocks are booming, I'm considered a perma bear. And guess what's going to happen? When stocks are falling, I'm going to be considered a perma bull, and I don't get it. It's just the way it is. I'm okay with that. I am okay with that. It stinks because being a value investor means you're basically always considered wrong. Because when stocks are flying high, you're being conservative, you're an idiot. When stocks are falling and you're being aggressive, you don't get it. All right. That's the issue. Guys, but most important, I want you to only do things when the numbers make sense. If you understand that, like Cintas is a very easy business to understand. Very easy business. They do uniforms. They do, what are those called? Runners? We had them in Shaker.
They call them runners. They'll call them mats.
Mats, thank you. Runners, mats, whatever it is. They do these fire extinguishers. They do these simple things. That's a very easy business to understand.
Matt wanted to know if the robots will be wearing the Cintas uniforms in the future.
I hope so, because they don't look good right now, those robots. They're naked. It's kind of offensive.
But we had some other comments to jump in here, too.
How many times have I been to Chipotle today?
Yeah. How many times you're going less, right? You're going less
yeah,
each
I go
week.
less only because Lisa and I, when I'm alone, I go all the time. Like when Lisa's on a trip or she's out or she has plans, like this weekend, she had a baby shower. I went right to Chipotle. Because Lisa's great. She'll have Chipotle, but she doesn't like it, so I don't do it.
She's just not going to have it 17 times in a week.
Right. And then when it comes to lunchtime here, like I usually have lunch plans with somebody. So the idea of saying, hey, let's go to lunch at Chipotle, not many people are up for that. I know we go to Chipotle Taco Bell. I know.
You got to pick some new friends and partners.
All right.
I had a killer bowl a couple weeks ago. Okay. So the other questions was, okay, your airplane stock. I don't know if you want to tell them or not.
Oh, it's an airport stock, not an airplane stock.
Isn't it PAC?
Yeah, Grupo Day, whatever.
Yeah, Rocket.
But
Mike,
it's under $2 billion, so we're really not allowed to talk about it.
I think it's over.
Is it over $2 billion now?
Yeah, let me see. I pulled it up right here.
I don't pay attention.
$12 billion.
Oh shit. Okay.
Yeah.
Maybe I was wrong on that one.
I have an article for you to look at in a second.
Okay.
But
thanks, Joseph.
Somebody else asked about price to sales. I'm looking for that comment.
Price to sales ratio.
I'm looking for that comment.
By the way, thanks to Joseph for that comment. My company.
Nick, can you help me find that comment? Where did it go?
Adobe to the moon. Adobe's probably going to go to hell before it goes to the moon. That's what has to happen, guys. It's so funny to me. Like people look at my thesis and say, you're wrong. I'm like, well, according to my thesis, then you should have never bought Palantir at $5 a share. It's easy in hindsight to say it's an awesome stock at $5 a share. But anyways, U.S. employment falls by 911 in government revision, revealing weaker than reported jobs market. Yeah, guys, listen, we're not here to predict recessions. It's an impossibility. In the last 10 years, I've seen like 80 indicators that are major about recessions. We just keep printing money. And the only one they had was COVID. But there's a lot of just look at our rentals, our house rentals. We've seen a slowdown in the number of people renting our houses. We've seen it harder to get, more rents. Now, I also think that's a combination of, the houses we have to do more renovations for them. The pictures have been bad, et cetera. But, all these things I look at going, okay, I have a brand new house that I bought, newly renovated. It's beautiful. And I'm not getting the rent that I was hoping to get. I was asking a little aggressive number, but still there's indications. You see home loans, you see credit card delinquencies, you see car loans and delinquency. These are things that, guys, for you to not pay your home mortgage or your car loan, things got a bit pretty bad because you need your car to go to work.
Yep. So Angus has a couple questions on that. He just said, hey, question, if you were to think that there was going to be an economic hardship coming, what percentage would you set your portfolio in cash, stocks, and bonds?
I just continue dollar cost averaging into those lowest cost ETFs. And if the stocks fall the prices I like, I continue to buy them. Don't play the game of trying to time what's right and what's not. Now, if God came down and said, Paul, these are the exact percentage, the exact levels the market would be at in the future dates, I would just sit at home, I would retire, I'd sell everything here and just do that. But that's not a possibility. It sounds, nobody's ever won the game by trying to guess where the market's going. Learn from me here. Learn from me here on that one.
Paul, can you help us? And I even say me in this.
Help me help you.
Can you help us through the emotions for a second? And I'd say that
look at gold.
Honestly,
look at gold. $3,700 an ounce.
Yeah, it's crazy.
People said I was stupid for having gold.
Honestly, for a second, during COVID, it would have been a sweet time to buy when the market fell.
Yeah.
But literally, you're buying at the time that people think it's, the world's ending. When Meta was falling so much, it was like a horrible company. It was going to be in trouble.
Yep.
Like, how do you fight through the emotion of the story is just not matching up to the numbers?
Okay.
Because you can look at the numbers, but your emotions are still there.
So this is the most difficult thing. First off, surround yourself with like-minded people. They're going to talk you out of it. Second, those people should remind you how many companies in history through economic downturns have gone to zero or have even fallen by 80 or 90% permanently when the fundamentals got better, when the fundamentals were getting better. I always pull up the chart of the stock market over long periods of time, and this is what it does. It does this, but along the way, it's doing this, right? And I tell people, okay, when would you have wished you bought? I'm like, here, 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 blah, blah, blah. And then I say, okay, what was the story at those times? That's why it's great to dollar cost average. Because if you have some guts, you increase your purchases when you're below the valuation mark. It's not easy. investing is not supposed to be easy. The great part is the easiest thing you can do in investing, a lot of people won't even do because it's so easy. They think they got to do something else. But being emotionally strong in it, if this is exactly why we have the community. It's amazing to see people get excited over down days. It's amazing to see people get excited when a stock has fallen a lot. It's a completely different world in our community than outside. Go ahead.
That's exactly what Angus just said. He said strong-minded people. That's why I'm here in this live
you have to be around those kind of people. Yeah. You have to, because guess what? I will say Tom Blue in the face. Look at Southwest Airlines. Let's pull up Southwest. I own Southwest stock. Don't ever own a company because blah, 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 because I do it, etc. But look at this. You know what I love about our community? The community doesn't agree with me. They're a hold on Southwest. That's what I like. This is not just a bunch of lemmings who are sitting there saying, because Paul likes it, we like it. No, everybody's like, a lot of people are in disagreement with me on this one, which is great. It allows people to think independently. And guess what? The strong person will be like, you know what? I hear what you're saying, but I'm still going to do this. Or a strong person will say, oh, wow, I didn't think about that. Yeah, that changes my thesis. The tin can theory gets me through everything a lot of times. The tin can theory is, if you bought like the Dow 30 in 1960 or whatever the year was, 1955, and you never sold it and just put it away, you beat the market by like 1.5% a year. And in that time, you went from 30 stocks to 26. It involved mergers, bankruptcies, all these other things. What it goes to show is you bought the biggest companies in the US in 1960, and you never thought about it again. You beat the market by 1.5%. That doesn't sound like a lot. That's a lot. That's a lot over a 50, 60 year period. That's a huge amount of money. How much? Let me actually do the math for you. 1.15 to the power of 65 is 8,800 times your money. Sorry, 1.115 to the power of 65. 1,182 times your money. 1.1 to the power of 65, 490 times your money. So you have 2.5 times more money with 1.5% extra return. Now that's 65 years. Nobody's saving for 65 years because we're not living to 150. I get that. But the point is, it's a substantial difference by doing less. You just got to remember that. When you are feeling the most angst inside is when you got to sit there and say, okay, what does this mean though? Talk to people. What are you doing right? What are you doing wrong? What do they think? It's hard out there, guys. Investing is not supposed to be easy. If you think it's supposed to be easy, investing is simple, not easy. It is simple, not easy. That's very, very important. Joseph, you're right. Make money boring. It won't be stressful. Yeah. Oh, Jake, I own Love too. Love the dividend. And the dividend's down a lot from what it was before. Yeah, next, that's what we're talking about. Lulu, it's coming out. Video's coming out Thursday on this.
Arlen found that price to sales comment. It was Solmo.
Okay.
Had the price to sales question.
What was the question?
How do you know the approximate average price to sales for each sector?
Oh, so this is hard because in an overpriced market, you got to go in there and see a sector. I'm sure there's somebody out there that has sector-driven price to sales. What I will say is this: the higher the profit margin, the higher gross margin, the higher the price to sales ratio should be. Because obviously, when you increase sales, it can really increase the profit dramatically. The lower the price, the profit margin, the gross margin, the lower the price to sales is going to be. I think the overall market right now is like 3.2 times price to sales. Historically, it's like 1.5 to 2. Now, I do believe that over time, the price to sales ratio should be higher because 100 years ago, when you wanted to make money, you had to build big factories, have a lot of employees. We're becoming much more service and technology driven, which means higher margins, all that stuff. So I do think the margin should grow. And if you look at the 10-year PE ratio, it has been trending upward over the last 100 years, but it still averages 17 right now over history. Should it be 18 or 19 now? Probably. Yeah, the price of sales, it's just a good indicator to look at of saying, okay, well, like software business versus a car business. The car business is like half 0.5, but then you see a company like Ferrari, which is a car company, but guess what? Their gross margin is 50%. The gross margin in the rest of the car business is like 15%. Very different car company. Still a car company. Still a car company. What else we got?
All right, we have a guest.
Oh,
Arlen's in here again.
Arlen's back?
Yeah, you guys, we're going to have you guys do a retirement calculator together, but I want him to share his story. Nick's bringing him in.
Is there a good story?
Just his investing journey story, as well as maybe you guys can talk quickly about, there was two stocks that were being mentioned in here. Intel, if you guys want to talk about Intel, and also talk about what was the other one, Nick? I just saw it. I know somebody keeps asking about VTS. I don't know if Paul knows that. I would say talk to Dalton in the community about an energy stock. Although you do like nuclear energy, though.
I think nuclear energy is absolutely necessary for us to become energy independent in the long run. It has a bad rep. It is way safer, multiple magnitudes times safer than people give it credit for. All we think about is Chernobyl, and we think, oh my God, it's terrible. Nuclear energy is incredible, highly efficient, and it generates a crap ton of energy. When people bash it, I just laugh.
But yeah, Dalton will definitely just talk to you all day about that inside the community. So anyways, Arlen's on.
Arlen, what's going on, man?
Hey, Paul, what's going on?
Not too much. So you're gonna do some retirement calculator with me, huh?
Yeah, I was gonna say. So to Tim's comment earlier, the reason that I had put in for the previous appearance, the reason I put in 30% to my IRA is because I before I found EM, I had not been putting in any money to my IRA, and so it just made sense. And I actually also, to Tim's point, is I ran the retirement calculator and did a lot of numbers for what I'm going to be spending, and just said, hey, it's going to make sense for me to put in 30% for the time being. And I have, because I'm commission based, I have the disposable income to do that, and so it just made sense. So yeah.
Awesome. So tell me, how old are you right now?
38.
That took a long time for you to answer. I'm wondering why that was. And what age do you want to retire?
I would like to retire at, I was going to say, let me actually pull up my retirement calculator.
Oh, good. Yeah. Pull up what you put in.
I would like to retire at 50.
Oh, 12 years from now.
Yes.
I hope he gets
So,
it.
Arlen, can I
That's
ask you a question?
Yeah.
I always want to do everything money. But I said to my wife just last night, I said, at 50, I'm 44 right now. I just turned 44 2 months ago. I said, at 50, I'm going to make a decision about I always say I'm semi-retired now, but I've already started telling Tim, let's record later. I want to get to the point where I don't even come in the morning. I don't come in until the afternoon, and I'm just making videos and doing content like this. And even if we sell all the real estate, I want everything money to exist forever. But I absolutely at 50 go, maybe I should consider just like being done. So I like that you said that. So what's your current savings at right now?
Current savings, I put 40,000.
Okay. And what do you save annually?
30.
30,000, correct?
30,000. Yep.
Perfect. And how much are you increasing that savings every year percentage wise?
I put 1.
1%. Okay. I think you could probably do better, but I get you. And so what'd you put for your annualized returns assumptions?
So annualized returns, I put at 4. I know market average or just normal inflation is about 3.5%. So I put in 4. And that's not including any options that I do or any other additional income.
Wait a second. Why'd you only put 4% in for your annualized returns?
Just to be slightly above the 3.5 inflation rate. So if I stay at inflation, it's 3.5 average, and that's not including any options.
No, hang on a second. So, what I'm saying is this: are you on the top right of annualized return?
Yeah,
so annualized returns is what return are you getting on your investments?
Yeah. So
you say 4%?
I assumed 4%. I know normally it should be 9.5, maybe 10%. If we were fair value, it should be higher. But I just put 4% just to kind of assume worst case scenarios. But I mean, I could do 9% or 9.5, which is market average.
I agree with you to be more conservative, but I'm not going to lie to you. You can get a higher return on treasuries right now. I wouldn't put 4% in there. I think that's extremely low.
Yeah. Well, and that's the point that I started doing is I said, okay, let's test the numbers to see what the breaking points is. Let's do it.
Yeah. Okay, so what'd you do for during retirement? What was your return? -5%? I'm just kidding.
I did annualized returns during retirement. I did 9%, so a half point below average market returns.
So wait a second. You have 4% while you're working and 9%, and 9% while you're retired.
Yeah, it can if it's in a normal ETF.
So
which
why
I
do you
could
have
actually reverse those.
Yeah, I mean, if anything, I would have thought if you told me you picked 9 and 4, I would have thought you did 9% for while you're working and 4% while you're retired. Listen, let's continue on with this, but I also want you to know to their point is in the next 12 years you want to retire, market returns probably aren't going to be fabulous. But if you dollar cost average, you should do pretty well. But I want you to know, like, if you invested at the peak of the market in 2000, and let's say the market fell in half today, you still made like, if you dollar cost average, you still made like 9 or 10% returns on average, annualized. Yep. So I look at it going, I think you're being conservative, and I'm a little confused by during retirement, usually people go with a lower number. Okay, so what age do you think you're going to live to?
90.
Good. And inflation is going to be what during your lifetime?
3.5.
Okay. And your current income's $100,000 a year. And
I put 75.
Is your current income?
Yep, I put the current income as 75.
Okay, and then what percentage do you want to live off of in retirement?
20.
So you're basically saying in retirement you're only gonna make $15,000 a year?
Yeah, exactly. 15,000, and that's assuming. So it's funny. It assumes I'm actually here like 3 to 6 months max, and I'm over in Ecuador for a majority of the time.
Well, I hate to say it, but you have enough for retirement.
That's what I'm saying. That's what I was shocked at, because I started doing the numbers and I said, "Holy cow! Like, what do I have to do? What's the breaking point for where the numbers are?" Because
I forgot about that. You can live in Ecuador. I mean, I'm shocked by this. I mean, guys, there's an old Stoic saying that wealth is about needing less and wanting less, not having more. And I look at you and I look at this 15,000. I mean, I living off $15,000 a year, that's incredible. And good. The funny thing is, your net worth just keeps going up and up and up. Now, let's do it the way I would have done it. I would have done it this way. I would have just said, let's call it 7 and 7, 7% returns for the next 12 years and 7% during retirement. Even more money. Actually, about the same amount of money. Exactly. I mean, you have enough. That's incredible. Arlen, but that's your fluke situation, though. You're an absolute fluke situation because I can't. Wow.
So this is the thing. If I do analyze returns, say I take it up to 11%. That's only increasing 2% based on options and whatever extra income it is. During retirement, say I reverse that and I did 9, say I'll do half of that, or I'll do 5. I'll do 5%. And assuming that's in T-bills or bonds or whatever it is.
You have plenty. You have plenty.
Exactly. It's even more. It just depends on how much money I want to roll over to generational. How much I want to leave.
How does it feel? Like, when you think about this, like, how does it feel to know? Listen, I know I have a lot of money. I spend an absurd amount. Like, spending $15,000 per year.
It's crazy. I mean, in Ecuador, it's totally like over here. Yeah, that's not realistic. But I've seriously, like, I already have a house in Ecuador. I'm already thinking about buying land in Panama, and kind of like you have a house in Mexico, I think.
We have 2 houses in Mexico, 1 in Turks and Caicos.
Okay, yeah,
but Turks and Caicos is expensive as F.
If I can't kind of keep redoing this, like, this is all income outside of this, and like the cost of living there, like how far your dollar goes is just insane. Like, it's absolutely mind blowing. So I could still live here for a portion of it, but if I only work for another 10, 11, 12 years, depending on how everything else goes, options and whatever else it is, and that's not even like 75 is not even my current annual income. It's higher. So if I'm
know
putting,
this is absolutely amazing to me that you must feel so like at peace with like. And the other thing is,
yeah, oh yeah, it's insane. I know. Every day I think about it. I look at the numbers because I know I have to do, I know I have to do one of these per month to get my points. However, I'm always going back and saying, okay, if I put this much, or even like, because I have a stupid low interest rate on my condo, and I'm thinking if I can take out this money and put it into the market and generate more with options and more just with the market, who knows when we're going to have a correction. But all these numbers I keep on running, and it's shocking how
that's
close.
incredible. Good
And
for you.
sure, I still have to like factor in all the stuff that I'm buying or cost of living and all that kind of stuff. But yeah, it's insane. It's
Good for
absolutely
you.
insane.
Good for you. That's really awesome. Good for you. I'm very happy for you. I can't even believe this. Go ahead, Tim. What were you gonna say?
No, I was just going to ask Arlen, like, so how is your mindset and just your investing style changed over the time you've been inside the EM community?
Investment style, and change. I mean, before I didn't even know what to choose. I didn't know how to look at balance sheets and any historical cash flow, like anything. So, um, to my point earlier, I wasn't putting anything into my IRA or 401k or Roth or anything at all. I was just kind of saving, and so that's part of the reason. Not like later, but I know the real estate investing came in later, and all of that stuff kind of clicked with me as well. And it just because I'm in the real estate industry too, I lease apartments, so I'm a pretty low guy.
Oh, look at you.
um, but I lease the apartments that are I typically stay at like Class A properties. Um, the Class B and Class C don't really touch unless the commission, again, to go back to commissions, unless commissions are high. And
Of
so
course.
I think, okay, to go back to the real estate, to the retirement calculator, I think this is the amount of income that I have to maintain. So I've stress tested all of the numbers that I have. And if I'm going to take another position, I say, okay, well, I have to put at least 30K into savings. And I know that this is the minimum that I have to do. So if I'm going to do a change, I'm going to put this into whatever it is. And I mean, my mindset is completely changed. Not, it's not even it's just totally changed. It's
That's
way
awesome.
different.
And I think when you were in before, you had said that you owned over a dozen stocks. But my question for you is like, how did you view a stock before coming over to Everything Money? Did you view it as a piece of a business, or did you view it as something else?
No. So actually that's interesting. So let me see, second, third, fourth, at my fourth building, I got into investing. And it was actually during COVID when we had tons and tons and tons of volatility. And the only way that I found out about stocks is because my coworker said, "Oh, you should start investing in BlackBerry. Like it's going up crazy and blah blah blah." And I had no idea how stocks works, none at all. Um, and it was shortly after that I found EM because I did get burned. I didn't have much in it at all, but I did get burned. And I said, okay, well, let me actually see how this works. Like, why the heck is the VIX up so much? Like, what does this all mean? So, I just started looking around, and then that's when YouTube did its thing, and I found EM. So I had no idea how businesses were valued. I never looked at it as a piece of cash flow, even debt, even shares outstanding, even just looking at shareholders' equity. I never looked at any of that stuff.
Wow, that's great. This is awesome. Like, listen, Arlen, I mean, I can't say it on blue in the face. I mean, I always tell, I know I live quite the life, but I always tell my wife, I wish, I wanted less because it's a much better way of living. And like you said, you're going to go to Ecuador. Money goes very far. I mean, like in Mexico, I always tell people, you will live like a king, literally like a king in Mexico on $70,000 a year. An absurd lifestyle. an absurd lifestyle. Like literally, you'll have staff, you'll have any food you want, you'll have great house, you'll have great living on the ocean, everything like that. Great weather. I mean, you will live like a king on 70 grand a year in Mexico. So good for you. And Arlen, thanks for being such a great member of the community and for learning the process and really applying it to your own method of doing it. That's really, I always tell people, I say it in the videos, Arlen, I'm sure you hear me. If you're looking for a stock to buy and somebody to tell you, we're not the one for you, but you clearly are somebody who wants to learn and get better. And I really do appreciate that, because nothing in this world aggravates me more than people who say like, well, what stock should I buy? And I have friends of mine who say to me, Paul, what stock are you picking? I go, listen, I'll tell you what stocks I'm picking, but you can't own them because you're not going to keep them when times get tough. And that's the other issue. Yeah. It's like, if you understand that a stock is a piece of a business and that the market price doesn't dictate the fundamentals of the business, then you're going to do quite well. But if you only go based on where the stock is, listen, I had a friend of mine, he was big on Alibaba for a long time. He gave up on Alibaba in the 80s. It's 145 now. I kind of want to be like, hey, remember how you gave up on Baba because you said it was dead? Like, okay, you wrote it down, and then what happened?
That's like the emotions question I was asking you
for
earlier,
sure.
Because if you're looking at the fundamentals of the business and saying, okay, it's a growing business, then you don't care about the price.
Yeah.
Temporarily.
Yep.
Yeah. Arlen, I just have one last question for you. And guys, like you guys in the chat, like we'll get to Paul's comments. He's going to do a Q&A and maybe look at a stock or two in a minute. But Arlen, one more question for you, because you've taken our options class. And so you've done like some of the live training classes that we've done. Paul's going to be sharing about our group, our current class that's getting ready to start, the Foundations Group Coaching. What would you say to anybody on just like the value you get from the live coaching? Is it worth it? Just what are your thoughts about it? Like, as we have this next class that's coming up.
Yeah, I would say, I mean, if you're like me, where depending on what stage you are, if you're like me, where before I was involved with EM, I would like 1,000,000%. I don't even care if you, I mean, just personal situation. If you had to take a loan to get access to the class, to buy the class, get it. Like,
wow,
just do it. It's, I mean, in the grand scheme of things, you're going to make so much more money because you're going to know what businesses are valued at. You're going to know how to look at cash flow. Like, you're going to know how to look at all these basics that are just going to set you up for success. Like 10 years down the road, you're going to say, holy cow, this was only like $500 for this. Like it's just, you're missing out if you don't participate in the class. And even if you're like, mid-level, I think Dalton is super high level, but if you're mid-level, I would say do it anyway, because I'm sure there's going to be little bits and pieces that you'll get. Repetition. I mean, you say you look at the not the pillars, the 5 statements every day. You repeat what makes sense and what kind of gets you to the next step. So if there's any holes in the process that you have, in your process that you have, even if it's a mentality, like you just said, mentality is the hardest thing. You're around like-minded people in this class. So just absolutely figure out what you need to do to get the funds there. Figure it out. It's going to be a win-win.
The Peter Lynch comment that everybody has the brains to invest, but not many people have the stomach. That's what I keep preaching more and more. And the more I got into investing, the more I realized that. And that's why it's so important to have that mindset and the right people around you. So anyways, guys, as Arlen was saying, we have a great foundations course, and this foundations course is geared towards everybody across the gamut of are you entry level? Or are you more advanced? We got to be speaking the exact same language. We have a lot of metrics on every company here. We have this software tool, and I always tell people, you've got to be able to understand what you're looking at. Data is great, but if you don't understand what you're doing and why you're doing it, it's not going to matter. It's 14 classes over 8 weeks, 14 live calls. It starts September 10th. And it's only $497. And the best part is, guys, you get 3 months of the software for free. This is small group coaching that teaches you a repeatable process. We're here to find quality companies, value them, and buy them with margin of safety. But more importantly, about the mentality involved. So when you see the numbers, you believe them and you know what to do in the future. You're going to leave with all of these abilities to understand the numbers, to understand the emotions and the attitude, and a clear plan for the future, whether that's retirement or like me, just slow down, whatever it is, that you have a plan for that future. Now, I will repeat till I'm blue in the face. Everything we do here is for long-term thinkers who want to learn and get better. It is not for people who are looking to chase hype. I don't want any hypesters around us. In fact, if you're hype in the community, please leave the community. It is not going to work for you. And it's not going to work for our people. And I don't want them to look at you and say, but if you're a hypester, a former hypester who wants to get better, that's all for you. I was that way too. 25 years ago, that's the way I was. And I cannot speak till I'm blue. I can't say that anymore. I'm so passionate about that. I do not want the wrong people around us because I want people who want to learn and get better. I don't care if you're just now starting your investing journey. That's all the more reason to be in it. So guys, if you want to get that start, and if you're new to our channel and just want to speak the same language, but you're more advanced, it's $497, starts tomorrow. It's 3 months free of everything money software. Join the Foundations live coaching program, the group. I guarantee you it will be a change for you and it'll be something you do for the future. But guys, like I say, learning doesn't start at night. It's not like college where you have learning and start. It's you sit there and you learn and you start and you continue learning. I always tell people I started learning after college. So go to everythingmoney.com/foundations. We're going to put the link in there below. But it's a great way to sit there. I'm sure people out there saying, how do I value a company? I remember I said that 25 years ago. I remember somebody bragging to me saying, I know how to value a company. I later learned they had no idea how to value a company, but this is so important. I think it's so important to have that understanding of us, all of us, to be able to speak the same language, that this is a game changer for you. So, and by the way, guys, this is a money back guarantee. If you do the work and at the end you come in and say, but you got to do the work, guys. It's not a money back guarantee. We're like, oh, I just got lazy and I couldn't make it because of it. No, if you do the work and you don't think it added value in your life, there'll be no questions asked, but you got to do the work. Money back guarantee. No risk involved for you. And you got to just do the work. And I guarantee you, you do the work, you're going to wake up a lot different person. So guys, go check that out. Guys, this is a great webinar because I told Tim, I'm like, God, I love talking about this kind of stuff. It really is exciting for me. I used to do this at my high school, but not when I was in high school afterwards, to teach every 2 weeks these seniors in the class. And I did it for free because I just love doing it. So now I get paid to do something I love already. And also it helps make me a better and better investor. It helps make me more aware of what I'm doing. And to Arlen's point, yes, he's very conservative on his numbers. I think overly conservative. The funny part is, so am I. But I'm doing it for different reasons. But we all have, Arlen's doing it for different reasons because he's moving to Ecuador. He's like, I don't care. I'm going to Ecuador. It's going to be super cheap. This is all about what we're trying to, you're going to pick it. Like, I'm going to remember this conversation with Arlen for a very long. I didn't know his assumptions were that low. Did you know that, Tim?
No.
I had never, I was absolutely shocked.
But at the same point, he thought it through, and I thought it was awesome.
Yeah, he really did think it through, and I'm going to remember this for a very long time. All right, guys, so thanks very much. What questions do you guys have? I'm going to do some answers. Go ahead.
Thank you, Arlen. Just wanted to say thank you. Yeah. And then also, you guys can always chat with Arlen in the community. He's in there pretty much every day.
What's his name in the community?
My Mouse Pad, right? Is that it, Arlen?
Is that what it is?
I think so. He'll type it in the chat. Yep. So what questions do you guys have for Paul? I know there was some stocks you guys were asking about. Just what other questions do you guys have? Drop them in the chat.
Drop them in the chat. Drop them in the chat. How is the market even doing today? I never even look at the market sometimes. Oh, look at that. The Dow's up. S&P and NASDAQ are down. That's incredible. What time are the sessions?
So first session tomorrow's 10 a.m. and then it's going to be Wednesdays with Paul at 10 a.m.
And they're all recorded.
Yeah, it's all recorded. So if you can't make it, and then with Dalton, it's going to be on Mondays in the afternoon, I believe 2 p.m. But we kind of send you a syllabus with all the links, the whole class. Like once you sign up, like you get all that info, as well as a couple of like pre-guides. So that way you're starting on the same page. But Paul's going to take you through a lot of stuff, guys, from understanding the metrics, understanding how to value a stock, the emotions part of it, which he was talking about today, which is such key. And so anyways, you're going to get a lot of value.
The big
for
part is
$4.97.
we have everything recorded, so if you can't make the session, it'll be sent to you. I did notice that Jake asked about Crocs a lot, so I'm going to do Crocs real quick. So Crocs. So first off, look at this with Crocs. Their 5-year average free cash flow is $630 million. Their net income is $580. And then last year, they did $770 million in free cash flow. Is Crocs like Lulu? Is it a temporary thing? They have high returns on capital, 20%, high gross margin, 60%. What is going on with Crocs? I mean, look at this. The price of free cash flow is 6. I understand why it's very interesting. We have 29 community members that actually, nobody has it worse than a hold. Is Crocs going to be around for the long haul? Let's see how they've been doing lately in terms of income statement. Let's go to quarterly. So this June, they did 1.15. Last June, 1.11. The previous June, 1.07. So not a lot of growth here. Not a lot of growth here. This is not a grower, but it's selling for 6 times free cash flow. That's the big thing here. Let's see 8 pillar thriller. Let's see what analysts think. Oh, analysts think there's going to be a drop but look at revenue, flat. I mean, this is not a grower, guys. The thing that Crocs needs to do is they need to buy back an F ton of shares. That's what they need to do. If this company is going to not grow, but have these big margins and stay at 6 times free cash flow, they need to spend every effing dollar they make on buying back shares. Because look at this. The market cap's $4.7 billion. Free cash flow, $760 million. In 6.5 years, they could buy back the entire company's free cash flow if the stock stayed flat. Well, at some point, it's not going to stay flat. How many shares are they buying back? 13% in the last 5 years. Those are rookie numbers. You got to up those numbers, guys. Who knows somebody at Crocs? Go buy back the F ton of shares.
I thought it was a fad, like whatever it was, 7, 8, 9 years ago when I would first start seeing people do it. And I thought that's going to go away. But I feel like I see people wearing them more than ever before.
Yeah, I see them a lot.
Is it like a lifestyle thing for some people?
Listen, Balenciaga is that luxury brand that made its own Crocs. It was a partnership with Crocs. They are buying back shares, but good God, they need to buy back every share possible. They need to buy back every share possible. All-time high of 183. They're currently at 84. This is purely, guys, the question to ask here is, do you think Crocs is going to be around for a long period of time? Do you think their revenue is going to go up? I don't know. It doesn't fit my criteria for the company I want to own, so that's why I'm not involved with it, but doesn't mean that you should be considering the same thing. All right, what's VST? Well, what's VST? I've seen that pop up quite a bit too. VST, Dynamite. Vistra Corp. What do they do? Retail energy providers in the U.S. Okay. Well, this is probably one of those companies where the financials are all over the board. No, not at all. Interesting. It looks like Valero brand. Its retail electricity business serves 5 million customers in 20 states, 40% gross margin, 5-year profit margin is only 3%, 1-year profit margin 13%. Their free cash flows seems a lot more consistent, $1 billion over a year over the last 5 years, 1.65 last time. But here's the issue. Big earnings multiple. So what's the attraction of this is my question. What's the attraction of this one? Oh yeah, LVMH. Matt, watch our video tomorrow. Intel's purely a turnaround play. It's probably my biggest risk stock and one that I thought would happen. I don't like the fact government bought it. Hey, Juan, I love you, bro. Lululemon dollar cost averaging. Your name is Jizzy. That's awesome. Am I buying PayPal sub 70? I have been buying PayPal. Let's look at PayPal. Again, guys, whenever we talk about a stock that I own, you're not supposed to buy it just because something on the internet. We're here to teach a process, like Arlen said. Let's look at the stock analyzer on PayPal. Analyzer. Oh, shit. What did I just do? I hit the print button. That's not good. I don't even have a printer set up to this thing. Here are my assumptions on PayPal. 3, 5, and 7% revenue growth. And look at this. Increasing ROIC. Profit margin, 13, 14.5, 16. Free cash flow is higher. 16, 19, 22. Same with the PE. I did 16, 19, 22, and 9% desired return. Hit the analyze button. This is why it's interesting to me. low price of 85, high price of 192, middle price of 130, all based on free cash flow because free cash flow is greater. But that's why I like it. And guys, PayPal is very secure, very safe. There is a lot of competition out there. Don't get me wrong. I'm not denying that at all. But they're working on being better for each customer.
Paul, I'd love for the community members in this chat to share their wins. We heard Arlen's wins. Like, what are the other wins that you guys are having? It could be something like, Arlen said, hey, he's up 2% on PayPal. He's upset he can't buy more. But it could just be even clarity on your retirement or whatever it is. That's
and by the way, I would recommend, is that Arlen, is First Amendment? Yeah. Arlen, don't worry about whether you're up or down on PayPal. The question you have to ask yourself is PayPal a good price right now? Should I add more shares? That's it. You don't know whether you're going to be up or down. Yes, it feels good to be up. Don't get me wrong. Especially if you're up on a like Alibaba. Nick and I are finally up on Alibaba, and it's been a while, right, Nick? But it's nice to see that. But at the end of the day, once you've built your position, that's when you should worry about being up or down on it. Our software is about $400 per year, $500 per year. Send them a link for that.
But even if you're in Canada, Jizzy, there's a trial that you can start out with. But what I would say is start out with this class because this is going to help give you the foundation.
Capital One Financial. Oh, wow. Capital One selling for 6 times free cash flow. Interesting. So this involves a lot of lending. So the question is, how do you value a company that does a lot of lending? I think this is something to have a conversation with the community about, especially with maybe like Dalton to see, because Capital One Financial, it's not like, I don't think it's like Visa where they're just collecting fees. They're doing lending. They're doing a lot of other stuff. It's not just fees. So I think there's a little bit difference there.
But up to 120%, that's good.
Oh, value seeker, definitely sell puts. If you want PayPal at $65, they don't have it right now, do they? Guys, look what's coming to your software soon. Options chain. So let's go to the puts for October 10th on PayPizzle. $65 pays $1.08. $1.08. You're getting $1 on 60. I mean, that's incredible. That's 1.6% over 1 month. That's a 20% annualized return to get PayPal at a cheaper price. How incredible is that? And guys, this option chain, don't worry. Don't look at this. It's going to be totally different. We're getting rid of a lot of these columns, and we're going to put calls and puts together. We're getting rid of change in price. We're getting rid of IV. We're getting rid of gamma, theta, vega, and we're keeping it, and it does all the math for you.
Got to keep that theta.
It's going to keep all this math for you.
Got to keep that theta.
I'm triggered.
But yeah, we'll have them stacked next to each other.
So it's $65. Strike price for then, it's a 19.5% annualized return. This thing is a total game changer. Love it. Keep IV. Why keep implied volatility? Interesting. Google's one of my bigger positions. Jake, I'm so jealous of you having Google. I didn't pull the trigger on Google because I was being too greedy. I was a greedy mofo. I wanted Google at $80 a share. I got to 83, so I didn't buy it. Same with Palantir. I got to 583. I wanted it at 5. I didn't buy it.
What's your thoughts on Home
Depot? Oh, Home Depot. Let's find out. It is on my list. Because your kiss is on my list. Well, our community members have it as a sell. It's selling for 30 times free cash flow and 30 times earnings. Pays a nice dividend of 2% that they can afford. Are the returns on capital good? High returns on capital, 30, 40%. Good growth rate. Reasonable acquisitions. Analyst estimates. Good growth of earnings per share. Guys, Home Depot is just a company where you got to go, am I buying it for the right price? Because it's going to be around for a very long time in all likelihood. What do value seekers say? Makes me want to come out of retirement back into software development. Oh, thank you so much. That's very, very, very kind of you. Email tim@everythingmoney.com if you want to come out of retirement, but he's kind of picky on developers. So anyhow, yeah, Home Depot, this is just a company where can you buy it for the right price? Here are my assumptions. If I want Home Depot at 12% returns, I got to basically buy it for under $300, and it's currently at $415. So I got a way to go for me. And these are the assumptions I made above. I think it's a premium company. I think it's great. I don't think it's going away anytime soon. I mean, at the end of the day, this is just a great company. Same with Lowe's. Same with Lowe's. Remember, all of these do not include the balance sheet. Steel Horse, great. I don't blame you. I don't know what you bought Home Depot at, but I don't blame you. If I had shares, I wouldn't be. Oh, thank you so much. Thank you so much, Angus. That's really kind of you. That's really, really kind of you. We Target has a low payout ratio, do they? I own Target. What's their payout ratio? No, it's pretty high. They pay out $2 billion, and last year's free cash flow was $3 billion. That's 66%, 67%. That's pretty high. I don't know, but they got good return on capital over the last 5 years. I mean, this is a company that's down since, but here's the funny part. I started buying sub 130. It went to 105, shot up to 180 something. And then now it's back down to 90. The question is it going to be, let's go look Stock Analyzer for Target. Do you think Target will be around for the foreseeable future? I did a 10-year analysis. I did 2, 3.5, and 5% revenue growth. I did profit margin of 3, 4, 5. Same with free cash flow. PE of 12, 15, and 18. I'm even being conservative. Actually, I don't even think this is right. I think I should be 14, 17, and 20. And 9% return. I think it's worth $160 a share. So if I want to make 12% on my money on Target and assume my middle assumptions, I have to pay $130 a share for it. Now you see why I was buying it sub 130. I just look at this going, I don't think Target's going away. I see women still loving it. Women still like to go places to shop. Shopping is changing and it will continue to change, but it all depends on what they're doing. Holy shit. Jake Robertson got an average price on UNH of 243. It's at 340 now? Wow. Wow. I hope Buffett's right on that one. He'll make an F load of money. Wow. It's up 6%. 98 community members have voted?
98 community members have voted on United Health. Yeah. Yeah. Amazing.
Use my referral code too. Oh, British Tobacco. Matt, I own British Tobacco. Again, what am I going to say? Don't buy it just because I have it. Blah, 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 blah. What the fudge? I can't type anymore. British Tobacco. I started buying British Tobacco at like $30 a share. It's at 56 now. It's at 10 times free cash flow. That shows you how cheap it was before. It was paying a 9.5 or 10% dividend. Now it's 5.7%. Shows you how cheap it was before. This is a company, unfortunately, they don't buy back shares. Barely. But look at all the X's here, and I own it. That just goes to show you that I don't care about. I look at it, it's tell a story. Analyst estimates actually have the earnings per share growing and revenue basically being flat. But again, if you pay a cheap enough price, it can make sense. But what they should be doing is spending their $11 billion a year buying back shares. Get rid of the stupid dividend and just buy back your shares. Oh, I wish companies would buy back shares that are this cheap. Yeah, it's almost a double for me. But again, I only knew that recently. It's funny. Recently, I was just like, somebody said to me like, "Oh, British Tobacco's at $60." I go, "What are you talking about? $60?" And that's where it is. 52-week high. Look at $60. I was like, "Holy crap!" I didn't know. I still assumed it was in the 30s. I purely bought it because I thought the dividend was safe. And I was like, "Listen, they buy back shares. Someday somebody's going to, they might diversify their cash flow, but I'm going to take the dividend for 10 years and whatever." That was why I bought it. Why do you see tobacco staying in this industry? Well, Angus, I feel like tobacco is always going to be around. The question is in what capacity. And I'm not saying it's going to be a strong industry, but just because an industry is dying doesn't mean that you can't get value there. If I were to offer you British Tobacco for $1 total, not per share, $1, how good of an investment would that be? Well, you make $11 billion next year in free cash flow. That's a huge return. Okay, what if I offered you for $11 billion? Well, would you buy it then? You probably would. Why? Because you get your money back in 1 year. So what price between 11 billion and $1 trillion would you pay for it? That's the mentality I want you to have. I don't want you to have like, oh, dying industry, therefore I shouldn't own the company. I understand that logic behind it, but I want you to look at it from a, hey, there's a price to pay for everything. What's that price? How much further does Target fall? No clue. And trying to guess that is a fruitless exercise. Because your kiss. All right, guys, it's noon here on the in Ohio. It's 10:30 was when we started. I am going to say goodbye. Guys, tomorrow, 10 o'clock, our class starts, $497, 3 months free of the software. That alone's worth a couple $100, $100 and some dollars. Let's get on the same page here. Let's up your level of investing. When we told our YouTube viewers, like 90% said 85 or 90% said they were trying to up their knowledge in investing. This is the way to do it. This is a great start. So I will see you guys tomorrow. Go sign up at the link, everythingmoney.com/foundations. And I'll see you then. Thanks, guys. Bye.